Hello, everyone, and welcome to our series on practice management for qualified financial advisors with Amit. As a part of the series, we are going to be focusing on picking up aspects about financial advisory practice, and Amit will share his insights that will help you manage your practice more efficiently. Today, we're going to be talking about one of the most crucial aspects when it comes to the relationship you share as an advisor with your client, which is establishing trust for the clients. In India, money is a very big taboo and people are not very open and comfortable when they talk about it. So my first question for you, Amit, is when a customer or a client seek financial advisory and when they search for an advisor through different mediums online, or when they get a reference of an advisor from somebody they know, and when they go to such an advisor, how should the advisor deal with that client when they come in for the first time? How should an advisor make the customer feel more comfortable and help them open up about the discussions and what they can expect out of them?
So, Anu, this is a brilliant question because first of all, trust is the sort of bedrock of relationship as far as an advisory business is concerned. And in that case, Stephen Covey has beautifully broken down that trust into two aspects. One, he says the advisor needs to be competent, and number two, needs to have great character. So it's all about two C's, character and competence. Because you are talking about a qualified financial advisor, that word qualified needs to be substantiated to showcase that one is competent enough, one knows the subject well. The second part about the character. Now, when I don't know somebody, it's very difficult to assess or gauge the character of that person. And that's why if somebody's come through a reference, that adds to that character. Because a friend that I know who's of high integrity and who would always think in my interest has referred somebody, that means this person should be trustworthy. So that's how it works. That's number one. Number two is when one is unable to assess the competence and character both, then they go by likeness. And what I mean by likeness is within India, I may look for Gujaratis, but when I go outside of India, I look for Indians. Okay, so that way, and it's not being ghettoizing things, but it's more of our nature. That likeness means if you are like me, and because I have high integrity, you also would have high integrity. So the trust gets established. But that's the bedrock. However, the way to establish that trust, either you go through a reference and also have the credentials, or when you don't have that reference, are you visible enough as an expert in various fora, be it public, be it social media, whichever way. These two eventually help. Now let's say somebody has already approached a QFA. In such a case, the most important part is to demonstrate that I care. And the way to demonstrate that is by active listening. Do I even listen to you? Do I then, as follow-up, ask questions about you and try to understand you more? But the moment I start pitching products, the moment I start pushing you, then establishing that trust becomes difficult. In financial advisory, we say that compounding pays over long term, so you need to be patient. Client acquisition and trust building also needs patience. If you wait, it's relatively easier to establish trust. If you are in a hurry, it becomes more difficult.
Very, very well put, Amit bhai. So my next question is, so we're in this age of branding, digitally, or brands for that matter. When it comes to a brand, a customer is, they tend towards establishing trust when it comes to a brand, right? But this entire ecosystem of financial advisors, it doesn't work that way where I would put up a nice big advertisement or a hoarding and a customer would look at my hoarding and then walk into my office and tell me that, hey, please give me financial advice, right? So in such situations, let's say if a customer were to walk into my office, how should I portray myself, as a brand individually and practically? You did mention that I can, for instance, showcase my own money and where I have put in my money, and how am I taking financial decisions. That adds credibility. But apart from that, what else can I do to showcase my good work to clients?
So you need to break it down into different business models. So I'll go back in the past. At one point in time, financial advisory was not important. Distribution of forms was primary requirement because the forms were not available. And in that case, a lot of intermediaries, the brokers, they opened offices at key locations. For example, in Mumbai, most of them had opened their offices in front of the railway station.
Right.
So somebody walking out of the railway station would look at an office and say, yeah, okay, this is a product that I want to buy, and this guy has a form.
Right.
So let me walk in and take it. It was a brilliant model at that particular point in time.
Right.
Because what the customer might need, you are showcasing that it's available here. Today, forms distribution is passing.
Yeah.
It's not required.
It's not relevant.
Today, advisory is required, appropriateness is required, suitability is required. And how do you showcase that suitability? You can't put a shop and say, I'll only give you suitable solutions. It doesn't work that way. Social media comes in handy here. As we discussed some time back, character and competence. Can I put my posts targeted at establishing my competence? Targeted at highlighting that my clients trust me. I've done something good for my clients.
Right.
Can I do those posts? That's number one. Number two, basic branding says some brands are very strong and some brands are reasonably weak.
Right.
The reason that some of the brands are weak is because the message that they give is clouded, not clear message, or they give multiple messages simultaneously. Stronger ones, they give a very direct and clear message.
Crisp and clear.
Absolutely crisp.
Right.
And crisp and clear is all about the prospective client or the existing client's ability to understand and comprehend.
Right.
It's not about whether I think it is clear or not. It's the market who has to think that this is clear.
Right.
So this is one part. What does it mean? My website, my office, my social media presence, everything should talk similar language.
Right.
If there is conflict there, then the client gets confused
It clears
and he
up.
walks to somebody else's office.
Fair enough.
Number two, people do not like controversies when it comes to dealing with money. I would trust somebody who's less controversial
Right.
or who's not controversial.
Absolutely.
Which means the moment there is an argument on social media, how do I behave? Do I also pull out my sword and start fighting in the street? Then a lot of clients will be put off, because then that's dirty.
Right.
If I behave in a matured manner by simply putting a polite message but a firm message,
Right.
then people do accept. Or sometimes remaining silent is a better choice. Divert the attention of the client somewhere else.
Correct.
Do another post, but be consistent with your message. That's how I would put it.
Fair
But
enough.
all the things which are customer facing, wherever the customer is likely to see the experience, let there be consistency. And final consistency comes when what you act or what you do
Right.
and what you talk, that has to be in sync.
Right.
The moment there is a gap, there is a problem. Just to give you an example, sometime back, somebody called me to take a look at his website, his firm's website. Now, this guy promoted SIPs in mutual fund schemes.
Okay.
And he always said, look at long-term SIPs, look at perpetual SIPs. But when you looked at the website, the homepage of the website in the middle showcased daily movement of Sensex. Now, when you talk about perpetual SIP, why are you bothered about daily movement of Sensex?
Right.
You don't even need that.
Yeah.
Right? That's inconsistency. And there are many such examples.
Fair enough. I think the way you put it is, so well said. I think it's a very good starter pack for people to actually start taking insights from there and start establishing a, digital brand, because customers today, in their lingo, are absolutely woke. They're aware of what they're getting into, and it's also possible because of the access to, information. Amit, my last question to you is that a lot of QFAs often face this situation when the clients walk in with extravagant expectations. They almost consider the QFA to be a magician and look for the magical wand of how they can instantly improve their financial situation. Now, of course, it's a patient journey. It is, a long journey. So how can the QFA convey that to the client without disheartening the expectations of the client, and yet establish the right trust and help the client have the right expectations?
You use the term magician, and yes, you are right. A lot of times clients come with those expectations. But whenever you hear of magician, people of my generation would remember a Houdini or a Kelal, the Indian magician. And one of the most famous trick of both these was they would get somebody, put that person inside a closet, and then the person would disappear. Right?
Yeah.
Now that magic is what the QFA needs to tell the client.
Yeah.
That if you are expecting a magician, then your money will disappear. The magician can do that.
Yeah.
The moment somebody looks at something which is out of the ordinary, there is to be a risk involved somewhere.
Right.
Lot of times that risk is not visible. It only means that the risk is not visible to me. It doesn't mean that the risk does not exist.
Correct.
Okay. So first of all, anything that is likely to deliver high returns is fraught with risks. If the QFA understands the risks, highlight those risks.
Right.
Ask those questions. Many good QFAs have dealt with this situation when the clients came with expectation of advice on cryptocurrencies. And by simply asking a few questions, the QFAs could at least establish that this is not a good place to put your money.
Right.
Number two, even in the well-regulated equity markets, there are periods where over a 1 year period, the money would have doubled. So those are exorbitant returns. But
Correct.
then there are periods where the money would have gone by half also.
Yeah.
Right? And in such a situation, it is always better to showcase long-term trend. Now, long-term trend and the returns is one part. The short-term ups and downs in between is a completely different story altogether.
Right.
The moment one helps establish that connection between the long-term upside and the short-term ups and downs, part of the job is done. Anybody expecting consistently high returns is actually falling into a trap, and that trap eventually will make somebody lose money. This is part one. Part two, sometimes somebody actually makes money in the short term and gains confidence. Now, there's a very fine line between that confidence and overconfidence.
Yeah.
The moment that line is crossed, overconfidence means that you don't worry about the risks.
Right.
And at some stage, that overconfidence turns into arrogance.
Yeah.
And that's the beginning of the end.
Yeah.
There are many anecdotes in the financial markets where the best of the best have lost money on account of this overconfidence.
Right.
And these could be the tools for conversation.
Correct.
If the QFA highlights some of these cases,
Yeah.
and there are, as I said, best of the best, excellent fund managers have lost money.
Right.
Why? मैं हूं ना. मैं हूं ना doesn't work because market says तू तो है but मैं तुझसे बड़ा हूं.
Right.
And then that really is where a QFA can demonstrate what is possible, but at the same time, the QFA is also, re-emphasizing that I know this subject, you didn't even know this incident.
Right.
That adds to the trust because that's competence.
Right. Now I have a lot of insights to help me build trust when it comes to customers that I serve. Thank you so much, Amit Bhai. Stay tuned for the upcoming episodes, and Amit Bhai here will share a lot of insights that will help you manage your practice of financial advisory better.